In AML compliance, not every risk can be handled the same way. Standard due diligence works for most clients, but for high-risk cases, it's simply not sufficient. Enhanced due diligence, or EDD, is a critical process used to identify, assess, and mitigate elevated financial crime risks. In this video, we'll explore how EDD works, when it's triggered, and why it plays a vital role in protecting institutions from regulatory and reputational damage. First, you need to get it right when enhanced due diligence is required. Then you need to know what are the additional measures that come with EDD in comparison to standard due diligence. Finally, you need to know how you will need to know how to perform EDD and the core principles of it. In this video, we will explain all three aspects. So let's start it. Let's start from when it is necessary to apply EDD. It is triggered when risk is high. It is that simple. Here are the most common triggers for EDD. It is applied when you have politically exposed persons, or PEPs, customers connected to high-risk jurisdictions, complex ownership structures, especially involving offshore entities, unusual business models that are hard to understand, or adverse media linking the customer to financial crime or corruption. In many regulatory frameworks, EDD is mandatory in these cases. But beyond legal requirements, EDD should also be applied whenever the firm's risk assessment identifies elevated exposure. This is where many firms fail. They only apply EDD when regulation explicitly forces them to. True risk-based compliance goes beyond minimum requirements. Now let's compare EDD with CDD, after which we will deep dive to performing EDD. In AML compliance, not all customers are treated the same. Some can be assessed with standard checks while others require a much deeper level of scrutiny. The difference is that customer due diligence, commonly known as CDD, is the foundation of any AML program. It is the process applied to every customer at onboarding by default. This typically involves collecting official identification documents, verifying proof of address, understanding the purpose of the account, the beneficial owner behind the account, and assigning a preliminary risk rating based on factors such as geography, occupation, and expected transaction behavior. These steps create a baseline understanding of the customer. In simple terms, CDD helps institutions establish confidence that the customer is legitimate. However, this baseline is not always sufficient. In many cases, risk is not immediately visible. A customer may appear legitimate on the surface, but may be connected to high-risk jurisdictions, or operate through complex corporate structures as mentioned earlier. These types of risks require a more investigative approach. This is where enhanced due diligence, EDD, comes into play. EDD is not simply an extension of CDD. Understand it as a much deeper process designed specifically for high-risk customers. In contrast to CDD, EDD focuses on validating, analyzing, and challenging the collected information. For example, under CDD, a customer may declare their occupation or business activity. But under EDD, that information must be independently verified, like asking for official document proof and even a certified copy of that document. Similarly, while CDD may identify a company as the customer, EDD goes further by identifying the ultimate beneficial owner, the individual who ultimately owns or controls the entity. This often requires asking for all layers of customer ownership in details, with all shareholder list and details, even a certified copy of such information proof. Another key difference lies in monitoring. While both CDD and EDD requires continuous customer monitoring, the frequency can be different. EDD usually requires a more frequent customer due diligence review and more scrutinized transaction monitoring than CDD. So if we break it down clearly, CDD establishes who the customer is. EDD builds a deeper understanding of the risks they may pose. CDD is standardized and applied broadly. EDD is targeted, intensive, and risk-driven. Now, let's look at how EDD is performed in practice. EDD is performed through a series of layered steps, each designed to build a deeper, more reliable understanding of the customer. The main objective is to verify it, challenge it, and assess whether it makes sense. The first step is trigger and risk identification. EDD is typically triggered when a customer is classified as high risk. Let's take example of a politically exposed person who has links to high risk or sanctioned jurisdictions. The first step would be, of course, common CDD process of data collection for identifying the customer and verifying the collected data. Because it is EDD, it would go significantly beyond standard KYC requirements. You need to collect detailed insights into the customer's business model, professional background, and the purpose of the intended transactions. Here, you need to pay attention that EDD requires in such cases to collect information about the overall financial profile of the customer, not just financial justification for the transaction intended. What does that mean? It means that if CDD requires only the source of funds information, EDD would require source of wealth information as well. This is to understand where customers' money is coming from. If we look at it in the context of a customer who is PEP or whose beneficial owner is PEP and is from a high-risk jurisdiction, as an AML professional, you should understand that checking in details the whole wealth of the customer allows to assess if the customer earns its money from legit businesses. If everything is clear and the customer can justify its overall wealth source being from legitimate businesses, then you would have done your job and still accept the client as high risk. Another aspect of EDD would be a rigorous assessment of ultimate beneficial owner check for high-risk cases like this. This is because high-risk cases may carry a risk of hiding of the true beneficial owner through layers of ownership. Once all relevant information has been collected and verified, a comprehensive risk assessment is performed. This involves evaluating the customer's profile, their behavior, and any red flags identified during the process. Based on this, a decision is made either to approve, maintain the relationship or apply restrictions or, in some cases, decline or exit the customer relationship entirely. Once this process is over, just like CDD, EDD also continues being an ongoing process including periodic review of the customer to assess risk level, continuous transaction monitoring, regular updates to customer information. Keep in mind that as new information emerges, the risk profile may change, and the level of scrutiny must adapt accordingly. This is to say that a high-risk customer may need to be downgraded to low risk, like for example if the jurisdiction of the customer changes from high to low risk. To conclude, we want to emphasize that the effectiveness of EDD depends not just on the steps themselves but on how critically and consistently they are applied. Because in AML compliance, understanding risk is an ongoing responsibility, not a one-time check. If you found this video helpful, hit that like button, subscribe for more videos on AML compliance, and let me know in the comments what should be our next video about.